The sixth learning objective is to use gross profit percentage and inventory turnover to evaluate a business. During the period, the business records the cost of all inventory bought in the purchases account. The balance of purchases is a gross amount because it does not include subtractions for discounts, returns, or allowances. All inventory systems use the inventory account, but in a periodic system, purchases, discount, purchases, returns, and allowances, and transportation costs are recorded in separate accounts. The entry to record the purchase and payment on account within the discount period includes a separate purchases discount account. During the period, the business records the cost of all inventory bought in the purchases account. The balance of purchases is a gross amount because it does not include subtractions for discounts, returns, or allowances. Net purchases is the remainder after subtracting the contra accounts from purchases. Under the periodic system, costs to transport purchased inventory from seller to buyer are debited to a separate freight-in account. The amount of cost of goods sold is the same regardless of the inventory system, perpetual or periodic. Cost of goods sold is computed differently under the periodic system. At the end of each period, the company combines a number of accounts to compute cost of goods sold for the period. A summary of Chapter 5. If a company is using a price tag stamped on the good to ring up your purchase, the company is probably using a periodic inventory system. If the company is using a barcode scanner to ring up your purchase, the company is using a perpetual inventory system. All purchase transactions are between the company and a vendor. In a perpetual system, every transaction that affects the quantity or price of inventory is either debited or credited to the asset. Inventory based on the rules of debit and credit. Increases debit inventory. Increase in quantity or cost per unit. Decreases credit inventory. Decrease in quantity or cost per unit. All sales transactions are between the company and a customer. In a perpetual system, each sales transaction has two entries. The first entry records the sales price to the customer. You debit cash or accounts receivable and you credit sales. The second entry updates the inventory account, debit cost of goods sold and credit inventory. When customers return goods, two entries are made. The first entry records the returned goods from the customer at their sales price, debit sales returns and allowances, and credit cash or accounts receivable. The second entry updates the inventory account, debit inventory and credit cost of goods sold. When customers pay early to take advantage of terms offered, it reduces the amount of cash the company receives and the sales discount is recorded. Closing entries are made at the end of a period to all accounts that are temporary. That means not on the balance sheet. To close an account means to make the balance zero. The form of the income statement can give users more information for decisions. The multi-step income statement with more subtotals has more value than the single-step income statement. Regardless of the form, bottom line net income or loss is the same amount. The preparation of the statement of retained earnings and the balance sheet are the same for merchandising as they are for service companies. The only difference is the addition of the asset account, which is inventory. That's on the balance sheet. Remember, ratios serve as an alternative way to measure how well a company is managing its various assets. If you still have questions, please give me a call. Be glad to talk to you.